Thank you so much for joining us today. I'm Dave Davis, and I'm excited to be part of this conversation. I regularly get the opportunity to speak with Steve Wyatt for short news segments on News on 6, but I'm looking forward to going a little deeper with all three of our panelists here today. 2025 is looking to be a year of change, with the shift in U.S. presidency likely to have ramifications, not just for the U.S. economy, but for the world. With this in mind, we have BOK Financial Chief Investment Officer Brian Henderson, Chief Investment Strategist Steve Wyatt, along with Kavanaugh Hill Investment Management President Matt Stefani, all joining us for a look ahead at what's for the U.S. economy, the international markets, financial markets, and energy. Good morning, gentlemen.
Good morning. Good morning.
So, Brian, we'll start with a wide topic. Get it going with you. What do you think is ahead for U.S. growth?
I mean, there's a lot of reasons to be optimistic about economic growth here in the U.S. this year. And certainly the U.S. consumer is a bright spot, but there's going to be other factors that are going to be driving economic growth. That, Steve and Matt, I want to join in here and talk about some of the positives for economic growth. But as I said, when you're looking out at the economy here in the U.S., you can't ignore the U.S. consumer. Consumer spending makes up close to 70% of overall economic growth, and what drives consumer spending is increases in income, and that's coming from many sources, investment income, rental income, interest income, dividend income, but the really big driver is just job growth. And so when you start to look at the employment situation here in the U.S., what you've seen over the last couple of years is the job market isn't as strong as what it was from just a couple of years ago. I mean, we've seen the unemployment rate rise from extremely low levels of, near 3%, but they're still very low at, just above 4% now. Okay? Still, in the big scheme of things, a pretty healthy, job market. We just got new job openings numbers yesterday from the federal government. Well over 8 million jobs that businesses are looking to fill. That exceeds the number of people that are looking for jobs. That's a very unusual environment that really goes back to the pandemic. That we didn't have that kind of situation. And so, I think the outlook for consumer spending from job growth is very positive. It makes me feel more confident that we're going to at least be able to realize growth of 2% after inflation. The other big driver in the big scheme of things for consumer spending, besides just a healthy job market, is just the wealth effect also. And it's you look at overall net worth levels here in the U.S. Over $160 trillion. That has increased by almost 50% in the last 5 years. That makes people feel very good about their financial situation as far as making big investments and spending money. Okay? How did that happen? Well, a lot of it has to do with the rise in financial asset prices. You look at the U.S. equity market up near all-time highs. If you own a home, for the most part, nationally, home prices are also very high. That all goes towards increasing overall financial asset values for U.S. consumers, and the consumer is not over-levered, relative to the incomes that are being generated. So I think that combination of strong job market, strong job demand, as well as just the financial conditions for the U.S. consumer really sets us up well. But that's not the whole story as far as drivers for the economy. And so, Steve, let's start with you.
Yeah, Brian, look, we've talked a lot about the resilience of the U.S. consumer as we've come through the pandemic. Another area of resilience has been government spending. In fact, that was probably something that as we were moving through the pandemic, and the Fed was raising interest rates aggressively, it helped cushion the blow of the Fed raising interest rates as aggressively as they did. So look, short-term running deficits of 6 to 7% of GDP has been additive to growth. There's some longer-term implications of that might not be quite as positive as we move forward. But as we think about 2025 and the changes that we mentioned that are coming, there's some excitement around the Department of Government Efficiency and what that may mean from a government expenditure standpoint. It's going to be hard to make a big shift in 2025. And as we look at how the federal budget is constructed, 60% of it's mandatory spending. So that's the entitlement program, Social Security, Medicare, Medicaid. Most of that's indexed to inflation. That's going higher. If you get to the part that's not mandatory, There's three big areas. There's non-defense, defense, and interest expense. Well, I can tell you interest expense is going higher. We're spending more for interest expense. I don't know which way defense spending is going, but it's probably, the world's no more stable than it was 2 or 3 years ago. So let's say at best that there's some opportunity for defense spending to be flat. That just leaves about 17% of the government, which is where everything else lives. So I think a review of our spending priorities and the ability for something like the Department of Government Efficiency to find some areas of waste, that's there. But the idea that we're going to get $2 trillion in savings is probably not realistic. In fact, just this morning, I think Elon Musk was out backing that off to maybe $1 trillion. But the bottom line is this. Government spending may not be as big of a tailwind as it has been in the past, but it's not going to be a real headwind. And what we do know, though, is that the type of sustainable growth that we're going to need, that doesn't come from government spending. That comes from business and private investment. And Matt, there's some really great things going on there.
Oh, yeah. This is going to be the year of business spending. So we're excited for 2025. If you look at the consumer, let's say, on an A through F scale is a B. You look at the government spending, it's a C, right? We're probably going to be flat to maybe down or up a little bit, but it's not going to have a big impact. Where the impact is going to come is with the business environment. Think about what's going on right now. You have this move towards AI, and it requires an incredible amount of capital. At the same time, the 5 big tech companies, they combine for $500 billion in cash on their balance sheet. That cash is going to be spent over the next few years as they invest in AI. In addition, you have to invest in the power needs for AI. Now, this is all happening at the same time that some of the semiconductor spending that has been queued up for the last few years is actually going to show up on the ground this year. And so you look at that, coupled with this deglobalization idea that we've talked about for many years, the idea that since COVID occurred, there's a thrust to move manufacturing back to the U.S. When we realized 95% of our pharmaceutical drugs were made in China, and we didn't have control of that supply chain, there became a move to let's move things back to America, and I think that's going to also add to business spending. So you look at an economy and you've got a B in consumer, a C in government, but man, business spending is going to be an A this year, and we're really excited about potential for a really decent economy this year. And when I say that, 2.5% growth is well within the cards for this next year.
So Matt, just as an example of that, we just saw Microsoft make a pretty big announcement on spending from AI data centers. What was that number that they threw out?
Yeah, this is unbelievable. It'll have an impact on the total economy. They talked about last year having spent $50 billion in CapEx. This year they're spending $80 billion in CapEx. And if Microsoft's doing that, we know Google's doing something similar. Amazon's going to do something like that. Apple and Meta are going to follow suit as well. So we think there's a very attractive business case for artificial intelligence, and that's leading to investment. And you think about these companies who have all this cash on their balance sheets, earning 4.5% invested in government bonds, and that they can get these returns that they think are much higher investing in AI, and that cash is going to come off the balance sheet over the next few years.
You know, as you can see, this is a very free-flowing panel discussion, and we will have time. If you're at home thinking, okay, I'd like to ask this, or I really want to know this, we're going to have a Q&A session at the end, and I want to make sure to mention that the last 10 minutes we're going to do question and answer. There's a function that you're going to see, and you could submit some of those questions. So getting back to, let's go to the echo wave of inflation, if we are going to see an echo wave of inflation, kind of sticking with what's ahead for 2025. Steve?
Yeah, thank you, Dave. You know, look, inflation is a topic that has been top of mind for the several years now, really since we saw this burst of inflation. We peaked at something like 9% in the middle of 2022. Fortunately, we have seen inflation rates fall. And some parts of inflation are actually back to where they were before the pandemic. If you look at core goods pricing, which, by the way, my gosh, guys, if we could figure out a way to live on flat screen TVs, we'd be fine, because flat screen TV prices are collapsing. But you don't need to buy a flat screen TV everywhere. Unfortunately, you see stuff. Food prices are back up a little bit. In fact, we've just here recently with the outbreak of the avian flu, egg prices are back to record highs. There's always some of that stuff going on. But the real problem that we think that for inflation, one is the history of inflation is for it to come in waves. It's happened in the past, so that doesn't mean it necessarily has to happen this time, but it's happened in the past, and so we need to be cognizant of that. But we're still in a bit of resource-constrained type of environment. Brian mentioned unemployment's still at 4.2%. That's lower than what I learned full employment is in the economy back when I was going through my economics classes, where full employment in the U.S. was considered to be like 5%. So unemployment at 5%. So you take that, and then markets like housing, Dave, where we continue to see a lack of supply, which is limiting the ability for rents to come down. And that's really the areas where, as we think about as we move forward, where the Fed's got to be a little bit concerned. And then just some of these policy changes that we could be looking at from the new administration around tariffs, immigration, regulation. How that all impacts inflation is going to be a little bit of a question mark. Implementation is going to be a really big issue. What it's caused, though, already is that the Fed has shifted their outlook, where I think as we were, at the end of last year, thinking about 4 or 5 additional rate cuts in 2025. Now we're maybe thinking 2. We're down 1%. We're at 4.25 to 4.5 on Fed funds. Maybe we get to 3.75 by the end of this year. That's a lot less than what we were looking for just a few weeks ago.
Okay, Matt, I wanted to ask you about artificial intelligence as we keep going into this growth ahead, growth potential for 2025. What do you see in terms of artificial intelligence and how it could revolutionize the American economy?
Sure. Let me start with kind of the basics of an economy. You have an economy that needs to grow. And why does this economy needs to grow? This is super important. The fact is we have a lot of debt. We have $36 trillion in debt. That's about 120% of GDP. That's a very high rate, higher only, the only time it's been close to this is World War II. So we're at this very high debt level, and that debt is expanding at a rapid rate. Deficits are running about 6%. If that continues, we're going to be at 150% debt to GDP in as few as 5 or 6 years. And that could cause problems economically, that could cause a headline risk to growth. So how do you get out of that? Your economy can grow 2 ways. Either you grow by growing the labor force, or you grow by increasing the productivity of the labor force. In history, there's been 3 big productivity waves in the United States. The first one is the 1910s, 1920s, when we went to factory automation and assembly lines and the steel industry. That lasted for like 15 years. We got productivity gains for workers out of that time period. Second one is the end of World War II. You bring all these laborers back into the country. You have all these factories that were building tanks and aircraft are now repurposed for other purposes, and you got about a 15-year productivity wave in the United States following World War II. Now, it happened a third time, and starting really in 1985-86, when home PCs became a thing. When you first brought PCs into the home, brought them into the schools, you had this real uplift in productivity that lasted from 85 all the way until 2000 and the start of the internet kind of change. AI has the potential to be this next wave. And if that happens, if we can inflect our growth in the United States up 50 basis points, the debt to GDP level stays essentially flat. So companies are going to invest money in this, and it has the potential to increase productivity in the United States and accelerate the growth rate of the United States. If that happens, we could be looking at markets more like the late 1990s. We could look at an economy like we saw in the 1990s, where GDP growth grew 3, 4, 5% a year for a decade. So that's what makes us so excited about AI. Now, AI is not without its challenges, right? It's extremely power hungry. So you think about a Google query, you go on and type on, where's the nearest Starbucks next to me? That uses a certain amount of energy. If you type in a query like list the 10 founders of Starbucks, and the little star pops up on your phone and it starts thinking, that ChatGPT query that's being created uses about 10 times the amount of electricity. So one of the gating factors that we have over the next, let's say, 4 or 5 years is electricity in the United States. And we can talk about that later, but it is one thing that will increase investment in the near term and hopefully generate returns in the future. But I'm very excited about the potential for AI to inflect the productivity of the United States worker and increase our competitive advantage against the rest of the world. We own the companies who own the space.
And Matt, let me add to that why this is important. If we think about the demographics that we're here in the United States now, just in our organic demographics, Dave, our population growth is set to go negative sometime in the next 12 or 13 years. So this is where, as we've seen birth rates decline, if growth of the labor force is going to be important for us as it is, again, I would say this is where the opportunity for us to develop a cogent immigration policy that helps us avoid this demographic decline in the workforce, which would put more pressure on AI. But man, take the opportunity of AI and have a growing labor force, and you've got a really powerful combination for growth as we move through the next few years.
We want to move to international markets and tariffs. So, Brian, last word on U.S. growth ahead, and as we're on the topic of AI.
I think, when you're looking out at these investments and improvement of productivity are so key for growth in an absolute sense, but also just in containing inflation.
Correct.
Steve touched on it. I mean, there's no question about the aging of our population, and if we're going to start to curtail the amount of net immigration into the United States, fewer laborers, but also just more and more people, 10,000 people retiring every single day. I mean, again, those are hits to the labor force. So these investments and alternative investments in robotics and automation, those are going to be all key in driving overall economic growth, but also just allowing us to grow without generating, more inflation. So.
Yep.
As we move on to international markets, of course, some of the policies that President-elect Trump is proposing may have consequences for international markets now. Inauguration Day just about 10 days away from now. For instance, how might this proposed tariffs impact trade in the countries targeted? And I just want to open this to the floor to get us started on tariffs.
On the tariff side, the way I'm thinking about this, when I first heard about it, it was in the context of extending, tax cuts that Trump had put in place during his first presidency. And in order, given the debt, situation that we're in, what are we talking about extending debt cuts? What are we talking about lowering corporate tax, giving the government's fiscal situation? Doesn't make any sense to me. But tariffs allow you to have at least some revenue offsets to allow those tax cuts. But as time went on and you listen to the new leadership that's coming in, it's more than about generating revenues and lowering taxes. It's really about reshaping this economy and bringing factories back here into the United States, which, we've been through this period over the last 40 years of, globalization, increased trade. That's all been good for, lowering inflation and, bringing prices down and, increasing overall economic growth, not only for the U.S., but worldwide. But what it's left us with is that we are reliant on countries that are not our friends in some cases. And so these tariffs, yes, they could be potentially inflationary, at least in the year that they're put in place. So it's going to delay the Fed's ability to get back to 2% inflation in 2025. Yes, it's going to generate additional revenues for the federal government, but it's also going to pivot, I think, this economy from, it is deglobalization. At least starts it to provide incentives for companies to bring manufacturing back here. And I think, for the vitality of the U.S. economy, it's important to have a strong manufacturing base and not to be, all, service based. So it can be potentially a good thing that's going to, unfold over many years.
And Brian, I think it's important that we talk a little bit about how tariffs actually work. So let's say that we put a 10% tariff on everything that comes into the United States. It's going to have a big impact on things like roofing shingles, things like corn and wheat and other commodity-based products because the price will actually increase by 10%. But that's a small portion of what we import. And frankly, goods are only about a third of what the consumer spends their money on. So 2/3 of the consumer is not going to feel any impact on tariffs. The third that relates to goods, it's on the landed cost of the good. So for example, take an iPhone.
Say that landed cost again. That means the cost that as it comes in, not what the retail's going to pay.
Exactly. It has nothing to do with the retail price. So let's take, for example, an iPhone. It lands in the port of Los Angeles at the cost of, let's say, $300. The 10% tariff on that $300 is $30. That iPhone sells for $1,000 in a store. That's a 3% increase in the price of the iPhone. Now, the fact of the matter is, China's going to eat some of that, I think, by devaluing their currency. It's simple to do. You devalue your currency. Yeah, it's happening right now, and you see that happen. And what that's doing is giving some room for U.S. To add a tariff, but not to have it end up in the end consumer. And then the other thing is, with an iPhone in particular, if you ever bought one, you open the box, there's so much plastic and stuff in there, they could easily get rid of a few dollars worth of packaging materials in there and keep that cost at $1,000. So I think this thought that tariffs are going to hit, and a 10% tariff means inflation of 10%, is a little misunderstood in the market. Again, it will impact base commodities more than it impacts finished goods, but most of what we import is finished goods. And so I think the consumer will be buffered a little bit from that. All right, so I just want to make that point.
Yeah, and I think, Matt, look, we have the benefit of having seen this occur in President Trump's first administration. Right. And so we can actually go back and look at what happened to import prices when he first put the tariffs in. By the way, the tariffs that he put on China in 2018 are still in place. The Biden administration kept those there. But back in 2018 when this occurred, import prices did not go up. So to kind of Matt's point, it was companies did some things, consumer activity changed a little bit differently. So I think that the other part of this, and Brian kind of touched on this from our lens, is that tariffs are just a negotiating tactic. Look, every country wants access to the United States market. We're the biggest economy in the world. We're growing faster than anywhere else. And so every country on the outside looking in is going, we got to get in the United States. So I think what President Trump is saying is, look, that's fine, but how about some reciprocity here? Because we provide open markets to some of our trading partners that we ship goods to them that they tariff today. And so the idea is, how about we just have open markets? Or if you're going to take actions, think about Mexico and Canada. The tariffs that he talked about there were less about an economic issue. This was a social issue. This was around immigration and the flow of drugs. So there was it's almost like a social issue. But I think the way you make a negotiating tool effective is you're willing to do it. And that's where the benefit of having President Trump in earlier, where he actually did do some of this, it may be that we see some of these actions that we want to see and not actually have to implement the tariff. So I don't think any economist out there is going to look, none of us would sit here and say tariffs are good. They're not necessarily as bad as maybe what people are thinking, but this isn't. We're better off if we can get along economically without having to resort to tariff policy to do this.
One final thought on this, too, is one of the reasons Trump was elected is because of the view that he had a better chance of reducing inflation. And so what are we doing over here? Raising tariffs and increasing the costs of goods. And so, for one thing, a lot of the tariffs that are being talked about, yes, on autos, yes, on appliances, yes, on China, and yes, part of this is negotiating, but Trump cannot afford to have where all consumer goods go up, in a large portion, because it goes completely against why he's in office in the first place. Intermediary, type goods that go into manufacturing, yes, certain goods that are, protecting, the auto industry here in the U.S., yes. Goods where there's plenty of other competition, where there are U.S. manufacturers, I can see that happening.
Financial markets, we want to talk about these as well. They've already been moving in response to President-elect's victory and proposed policies. What do you expect from financial markets in 2025 once the new president and Congress take office again? Inauguration day coming up January 20th. They'll just open the floor.
Yeah, we've already expressed that we have a very positive view for U.S. economic growth this year in 2025. And so if economy grows, we're going to be able to increase earnings, high single, digits over the next 12 months. That's all going to provide support for the U.S. stock market. The other lever, though, when you're talking about stock prices is the multiple, price earnings multiples, where stock prices are trading as a function of earnings over the next 12 months. We're already coming into the market pretty high. Okay, I'm not expecting much in the way of multiple expansion. Yes, earnings growth is going to drive the majority of the equity market. If we're right that some of these productivity enhancements, start to come across the finish line, and we start to experience that in 2025. that allow inflation, to continue to come down, that opens the door, in our base case, for the Fed to at least cut rates a couple times. That's going to be good not only for a lot of the large mega cap stocks that have been where the performance has been, but it's going to continue to help what we've seen, here recently, at least since the election results, where small and mid-cap stocks start to perform well. You look at the bond market, which also tends to be a large portion of client investment portfolios. You're starting out with yields 4 to 5%. Corporate bond spreads are very tight, very similar to the high multiples that we're seeing in the equity market. It's not a great environment for bonds to see much in the way of appreciation, except for the shorter end. Bonds with maturities, 3-4 years and in, will benefit from the Fed rate cuts. So, but you should expect at least get your coupon, I think, for bond portfolios from here.
Yeah, I think what's interesting about when we think about bond investing or interest rates, as investors, we want higher rates. Of course, as borrowers, you're thinking, no, I don't want higher rates, I want lower rates. So we're kind of playing on both sides of that equation. I do think the other thing, though, Dave, that's been important, that's shifted since the election, is that sentiment, both on a consumer side and a business side, has improved pretty dramatically. What that's going to mean is that, even if the economic growth isn't 100% smooth, even if we're seeing some trouble spots from the implementation of some of the new policies, if people feel like the future's going to be better, they'll put up with some of that stuff and still move forward. And so I think these sentiment numbers that we've been getting are really important for us. Small business sentiment has just exploded to the high side, which is different than where we were on a pre-election basis. So I think that in the end, we've had 2 years in a row of over 20% on the S&P 500. We're not saying 20% again on the S&P 500. There's a wide range of price targets out there. You'll see price targets up 20 to down 15. We're probably in that 6 to 10% range is kind of where we would be thinking. It's not going to be a straight line. This isn't a coupon as we move forward, but still feeling positive about the financial markets.
Let me just add one thing in here. And so Steve mentioned that we've had 2 years of 20+% returns. We're in a bull market.
Yep.
All right. Third year of a bull market tends to be a year of digestion. You may get flat performance, but it doesn't mean the economy is performing poorly. I want to break those two out, all right? You could have a white-hot economy, a market that's priced for it, and then may go sideways for a little bit. Now, I could see that being how 2025 plays out, where we get some return, but maybe it's not a 15-20% return, despite the fact that we're looking at an economy that has really interesting things occurring. For the first time, let's say, in the last 20 years, you're seeing deregulation from the federal government's side hitting at the same time as a potential once-in-a-generation productivity improvement. It's happened a few times, but it's not something that happens every 5 years or 10 years. This is something that happens every 30 years. Like I said before, we saw this in the 1910s and 20s. We saw it in the 1950s. We saw it in the 80s and 90s. And we may be staring at that same sort of economic growth coming into these next few years. Doesn't mean that the stock market goes up 20% every year. All right? It may be a year where returns are more modest, but the economic backdrop is improving, and in my view has the potential to do something it hasn't done since the 1990s, and that is grow well above trend for several years in a row.
And that'll set the table for future gains.
That's
I mean,
right.
It's kind of like the market takes we know valuations are pretty expensive. That allows valuations to come down without the market. Stock prices don't have to fall if we see continued economic growth and earnings growth. But then that sets the table for the next leg up in the market.
That extends the bull market, and that I think is the most interesting part of our view is that not only is the economy potentially with upside potential, but that this could elongate the cycle even more. This productivity gains coupled with what's going on from a deregulation standpoint, or what we anticipate.
The financial markets, so if we go less than bull and we start going toward bear, how much would that affect consumer confidence, and would that make a difference in the economy? I mean, does the financial markets, to what extent does it actually affect consumer confidence?
I think it impacts tremendously. I mean, for those that are working, plus retirees, if they start to see this equity market fall apart, or like I said, it has helped sustain the stronger economic growth that we've experienced in the last couple of years in the face of the highest interest rates that we've seen, in over 15 years. Okay, how did we get through that? Yes, government spending, increased to sustain some of that, but also just investment gains, sustained a lot of it as well.
So yeah, if it's a positive, it could be a negative if we see a downturn.
Right. I want to move on to energy policy because obviously with the Biden administration, much more pro-green energy than the Trump administration is likely to be. Matt, I want to start with you. What else do you see in the shift in leadership in terms of energy? We've talked about AI and the energy suck that can be. Tell us more about that.
Yeah, sure. I'd be glad to. This is a topic that's very close to my heart, something I'm very interested in. If you look at what's happened in, say, Germany or England or some of the other countries in Europe, they aggressively approached alternative energy, green energy, wind and solar. And what's happened is the electricity prices in those countries have gone up so much that they're now really not competitive from a manufacturing standpoint. When you think about an economy like Germany, which based its entire economy on manufacturing, that's a real sea change. Now, here's what's crazy. The United States, if you watch the government, nothing happens quickly. In fact, it can be very frustrating to watch the U.S. government function. But it was designed that way. And the fact that it happens so slowly helps us avoid big policy mistakes like what have been made in some of these countries in Europe. There's a reason that there's a political crisis in France, Germany, and the UK, and part of it has to do with energy policy. We headed down the green energy path. We still believe in the green energy path, but we're doing that in a pace that makes sense. Now think about electricity demand in the United States. Let's move to that. For 15 years, the electricity demand has been basically flat. So increased demand has been offset by increased efficiency. What's taking place now over 2024 and going forward is there's a massive amount of demand for electricity from AI. How much demand? We think it is 50 to 100 gigawatts of additional demand in electricity load over the next 5 years. To put that in context, think of a gigawatt as being 1 million homes of power. So we need enough electricity to power somewhere between 50 and 100 million homes over the next 5 years to satisfy the electricity demands for AI. Because we're investing so heavily in data centers, we need this power to make those data centers effective and generate a return. But that creates economic growth, right? As you add capacity in the electricity market, you have to build nuclear power plants. You have to build gas power plants. You have to add solar and wind. Now, I think solar and wind will come at the expense of gas in this administration's portfolio of decision making, but they'll all have to play a part to be able to meet the demand need that is coming from AI. And I think that's an exciting prospect to look at. Again, this is after 15 years of no growth in our electricity demand. We saw this boom in the 80s and 90s, and we're going to see it again now. And I think that's partly helps the GDP outlook, but it also helps the energy security of the United States. Remember, we're the largest producer of oil. We're the largest producer of natural gas. So we have a production advantage. We have a cost advantage relative to the rest of the world. So if we can compete on a level playing field with the rest of the world, whether it's tariffs making them equal with what other countries are charging us, we can compete and win. All right, because we have one of the most critical input costs into manufacturing something is electricity. And ours is low. Ours is cheap, and we're good at making it.
That's where we're just so fortunate as a country to be resource rich in this. Because I think as Matt's talking about that, what you hear is that the countries that are going to win in the future are those that have access to reliable, inexpensive energy moving forward. That's what technology is going to take. That's where the future is going for us. That's where the United States has a tremendous advantage over many of our trading partners.
You go down the list of policies that we're talking about in the new administration with the new President Trump, and you go, tighter immigration, that's potentially inflationary. Tariffs, yeah, at the margin, probably inflationary. So where is it going to come to lower overall prices or at least slow the pace of the rise of prices. Ideally, lowering prices would be even better. And yes, at the margin, trying to cut out, government spending that's, wasteful probably helps a little bit, but not going to move the dial. The big one for Trump is this energy policy, increasing production. It's not all natural, oil type. Maybe it is natural gas, that sort of thing. But that is so key because, as Matt said, it does permeate through the cost of virtually everything that we do here. So that is very key in bringing the overall inflation rates down.
I want to remind you at home real quick, make sure to submit those questions. We have a Q&A function that you can access. And if you have any questions about what we're talking about, we're going to leave about 10 minutes at the end of our broadcast and our segment here to go ahead and answer some of your questions. So make sure to ask those questions now. Matt, you were going to say something.
Yeah, I was going to say, Dave, that, look, we've talked a little bit at the beginning of my discussion on energy about the slowness of our government. And it makes you wonder, well, is that really good? Is that bad? I just want to give you one thought on that. I looked at the 75 largest companies in the Eurozone. Do you have any idea how many of those were founded in the last 30 years? Only one of their top 70. And it's only a $50 billion valued company. Think of what's been created in the United States in the last 30 years. Amazon, Google, Meta, Netflix, we all love Netflix, Uber, Airbnb, all these new businesses that are global businesses. So you look and you think, well, is the way America runs, is it just ungovernable? Is it so sticky and slow to respond to things? Well, that's actually our competitive advantage. The government is not what drives these decisions. It's individuals making capital allocation decisions. It's individuals making investment decisions that create these businesses. And so I just want to leave a positive statement on that it may be frustrating from time to time to watch how the government operates. And we may be, oh, well, our guy's not in power or our guy is in power, and what happens? It really doesn't make that much of a difference when you look at what's been created in America the last 30 years, and when you look at the companies who lead in AI, they're all American companies. They're all American companies. This is going to happen here, and we're going to dominate that space. Remember, in 1989, we were 25% of the world economy. Japan was 22. All right, we thought we were losing to Japan. 35 years later, Japan makes up 6% of the world economy. We make up 26. We're in an economic battle with China. Again, we're about 26% of the world economy. China's around 23, 24. But we have the advantage because we have the political system coupled with the capital, again, $500 billion in cash on balance sheets of these big companies. And we have the innovation engine that works. We have the innovation engine that creates these new companies. So I just want to leave on that topic.
Let me just add to
I want to stand and salute.
And so you think about you're a citizen in Europe, and you're saying, "Hey, my economy isn't as strong. Do we have the right leadership?"
Yeah.
Last year was the year of the largest number of elections, and you're starting to see these other parts of the world wake up about, are we going down the right path? Are my living standards improving? Certainly, investor capital is flowing over here to the U.S. because this is where people are making money, and it makes, yes, valuations, when we're looking around, where do we place money? Some of these markets haven't performed as well. It's certainly, as well as the U.S. equity market in the last couple of years. But there's going to be change there. Here in the short term, you're going to probably see those central banks cut rates a little bit quicker than what we have been able to do. But why they're having to do that is because the economies aren't as strong. So to offset a lot of the structural issues. So that all creates investment opportunities too, though, for us.
I do think that's an awesome point. You've got a government that's basically collapsing in Germany, a government collapsing in France, a government collapsing in Canada. That does lead to change and creates opportunity. It creates opportunity because as change occurs, and that's what we're talking about here is a change in the regulatory environment in the U.S. and the positivity that we think that may bring. There are opportunities that can be created around the world as these governments change as well.
Yeah, Steve, I mean, just world governments and how that can affect it, specifically just kind of wrapping up energy policy here as well.
Sure.
Your final thoughts?
Yeah, I think, look, in the end, what we've been talking about is that we're in a uniquely positive position to kind of drive what the future is going to, what's going to happen from an economic standpoint. That doesn't mean that we ignore the rest of the world. It doesn't mean that this is the only place that you're going to invest your money. But I think but overall, as we sit and we talk and we think about the future, for all of the issues that you can point to that say, we have our warts, we have our issues, we live in the greatest country in the world by a wide margin, a country where each of us can define success as we see it and go have that opportunity to achieve that success. There's nothing out there that we see that's going to change that direction that we're moving, and I think the rest of the world's catching on, and they're going to be moving more our direction.
That's great. We have the Q&As that we were talking about and the questions that you have been submitted from all over the country. Thank you for joining us today. We really do appreciate it. This is a question that came in. President Trump has discussed reducing or eliminating bank regulators, including the FDIC, Consumer Financial Protection Bureau, and Federal Reserve. How might these possibilities affect the banking sector and the market outlook?
Look, deregulation is probably one of the more powerful parts of President Trump's policy platform that he came in. We read about, we're a diversified financial services firm. Obviously, we're highly regulated. We have a lot of interaction with every one of those entities that were listed in the question. None of us want to see a scenario where we reduce regulation to the point that we put our economy or businesses at risk. We need an effective set of rules to play by. We're all part of that process. At the same time, is it possible that we can look at at various scenarios now and say, man, there's a whole lot of overlap here where I'm not sure we're getting that much additional benefit from having these multiple entities looking at the same thing? I think overall we would welcome a review of that. But let's be clear, nobody's saying that we don't want any regulatory oversight. There's a need to have a solid set of rules for all market participants to play by, and we believe strongly in that.
Brian?
Yeah, I mean, and Matt touched on this, just the benefits of deregulation, and there's some things that can happen quickly. Maybe it's opening up permitting for any energy, exploration. When you're talking about, changing financial regulation, banking regulations, those can take years. Just the Basel III endgame has been going on as the latest phase, of regulations that really got started in introducing, after the financial crisis back in 2009. It still isn't even in place yet. And I completely agree with Steve. We have to have orderly markets. We have to have, fairness and certainly the markets have gone through, tough periods, and regulations have been put in place to protect those. But so even deregulation there would benefit it. One of the areas that I know the private equity, side of the market is all excited about is, in addition to the lower rates, tighter credit spreads that can, finally, unlock some capital that's been locked up on the private equity side where businesses are not being sold, is just deregulation on just the FTC side, where they're cracking down on the ability for mergers to happen. So that would also be a positive. I'm not saying wide rein and anything goes. We can't have widespread monopolies or anything like that running the economy, but there are opportunities for deregulation there as well.
I believe we have another viewer question coming up about LNG and exportation, and we can talk about this. Viewer question: what is your outlook for LNG exportation?
That's a great question. So we export about 12 BCF of natural gas a day. We produce about 100. So think of the market as being, let's say, 16 million barrels of oil, only it's in the form of natural gas. 100 is our base. We export 12. Over the next 3 years, we're going to be able to export 25 BCF a day of natural gas. Now, today, the natural gas price in the United States is $3.60 a thousand cubic feet. In Europe, that's $13.50, and in Japan, it's $13.50. It costs about $4 to move natural gas from the U.S. to Japan or to Europe. So if we're paying $3 They're paying 13. There's a lot of money to be made drilling in the U.S., exporting it via export terminals to Europe, and selling it there. And I think that's going to occur at a more rapid rate. Now we have the ability to export is going to double over the next 3 years based on what's already been approved. What I think is likely is that we'll see new approvals now under this new presidency that will increase that closer to 30 to 35% of our production will be exportable, or 30 to 35 BCF per day. So I'm very bullish on the gas market. I think that when you get above $4.55 a price in an MCF in natural gas, you're probably higher than the average is going to be. But we have the advantage. You understand that because we're the exporter, our prices will always be about $4 or $5 less than everyone else pays. So it's like locking in that competitive advantage. We're growing our exports, which is awesome. It's cash coming into the United States for product that we're selling to someone else. That's fantastic. But we're doing it at a price that keeps the competitive advantage in the United States. So to me, LNG is a great story over the next 3 to 5 years.
We have another question about tariffs, and we've mentioned it earlier, but we just want to circle back to this. It was such a big issue in the campaign. Can you talk more about expectations about the proposed tariffs? What will that mean for consumers, and potentially how soon would we feel the impact? Again, just kind of putting a bow on this tariff topic.
Yeah, Dave, look, the potential impact could happen relatively quickly. I mean, now there are things that the president has to keep in mind. Some of the countries that he's talked about tariffs, and he's used that term pretty loosely. I mean, he's been pretty free with the idea of throwing out tariffs. He thinks it's a beautiful word. But we have trade agreements with some of our partners that might limit when this can happen and how it's going to happen. I think the bigger issue is kind of what Matt talked about. It's getting down to what this actually means. This doesn't mean a 30% increases in retail price. It's an increase in the input cost of an overall good. How that actually impacts is based upon how the company may eat some of that. Consumers may change their spending habits. It may require us to buy a different brand of a good or something of that nature. So it's hard to say exactly what the impact's going to be. I think at a high level, we're not going to say tariffs are a panacea and they're good for everything, but they're probably not as bad as what you read sometimes in the press is what the potential impact could be.
But President Trump, he ran on putting tariffs on China, and I think Steve's exactly right. I think you're going to see in the early days you're going to see it. But also to Matt's point is he doesn't have carte blanche. He cannot put tariffs on everything from every country, and we wouldn't want him to do that in the first place. Right. So there are also restrictions. Yes, if there are concerns about drugs coming into the country that's affecting our society, yes, he has carte blanche and he can make some moves on his own without Congress. So I think part of this is just the scare tactic of, hey, I have some power here to do something quickly, and he's shown a willingness to do it before, so he's going to continue to throw that. He's going to throw that out there.
One could argue it forced the resigning of the Prime Minister of Canada.
Yes.
Really,
it's caused a shift in top of the Canadian government.
Yeah, that's big. We also have a question about home building and construction costs and borrowing costs. Let's get to this. So just general thoughts of your question here on housing, construction, and borrowing costs to get into those houses.
It's the housing market that the demand is there. We've underbuilt homes ever since the housing bust in the financial crisis as far as new homes being built. Thankfully, we haven't underbuilt multifamily apartment buildings because those have been record deliveries here in the last couple of years. In fact, while we all talk about rents driving a lot of the higher core inflation levels, there's some metropolitan areas where we've overbuilt multifamily apartment buildings and rents are actually flat or maybe even coming down a little bit. Even in the Sunbelt, where the population has been moving. The housing market, though, it's a difficult one because you think, well, how are we going to get out of this? As far, yes, it's one to live in an apartment, but you want to have a family, you want to have your yard. It's kind of the American dream. I think we all want to preserve that. But one, you have to have the supply of new homes being built in the right locations. The average, family out there, when you look at the average home price of, over $400,000, it's a tough one to bite off. Certainly, if you got mortgage rates above 7%, at least right now. Yes, over time, income levels will improve, but mortgage rates, we need some help here. Mortgage rates need to come down in order for it to be actually affordable.
I think that's been one of the troubling points about how the market has acted since the Fed started to lower interest rates. They've cut their interest rates by 100 basis points. The 10-year Treasury's up 100 basis points during that period of time. So it's actually moved the opposite direction. Now, there's a number of reasons, term premium and maybe some higher inflationary expectations. But to Brian's point and the impact on housing, mortgage rates are back up over 7%. And so we just have an affordability issue. I serve on the board here locally of Green Country Habitat for Humanity. We're committed to trying to deliver affordable housing in the Tulsa market. It's hard. The regulatory environment is hard. Overall costs to build are expensive. Lot costs are expensive. Labor costs are still expensive. And so when you think about builders building an affordable home, a $250,000 home, they're only going to make $10,000 or $12,000 or $15,000 to do that. And so it's just difficult to get builders to build enough of those homes to where you can do that. And then, the starter homes, and then where are you going to put them? It's normally if you're in a starter home, you're going to be, outside a metropolitan area, which increases commute costs and everything else. So I don't want to say it's impossible. Easier regulatory environment here would really help. Think about any of our listeners that are real estate developers. They tell you if they want to do a new project, man, that is a process to get it from purchasing the land, getting all the permits, to breaking ground, to actually delivering a unit. It's a big time process. So I don't think this is going to be quickly solved, but it is something that we need to continue to work on as we move forward.
We have one more question about wage growth, and we want to talk about this. A viewer submitted question here. Do you see a gap between the projected job creation and skills of the U.S. workers? Will it impact wage growth? Will that impact wage growth or lead to more inflationary environment again?
So, when I think about that particular question, Matt's talking about, construction of data centers. You didn't even mention, the demand for energy, even from nuclear sources that are, huge construction projects. And, nuclear engineers and all of that sort of thing, that you've got to have the workforce to be able to build out all that infrastructure. Where's that going to come from? It kind of gets back to what I was talking about with changing the direction of the economy and making sure we have a strong manufacturing workforce in order to build out this type of infrastructure, and not being so reliant on overseas companies to help us build out the infrastructure needed for the expansion of our economy.
Right.
And yeah,
we're going to do hour 2 on restructuring the education system in the United States. But there's a big need for training programs. There's a need for students to enter those training programs. But the beauty of America is that you are mobile between social classes, and you're mobile to move and seek jobs where they are. That's what makes us very different than other countries. Some places like Europe, boy, you're born into a social class. That's probably where you're going to stay. Here, the American dream is you can move all the way up, but it does require training. And so I think what you're going to have to see as we move to an environment where, again, we haven't had electricity demand increase in 15 years. That means net we haven't built anything in 15 years. So we have to learn those skills. It's up to our school systems and our companies to start funding that, to have the worker supply that they're going to need. And that is a process, and it is something that is a concern, but I think it's something that the free markets will address.
As we get ready to wrap up the webinar, I just want to give everyone their final thoughts, starting with you, Steve, and we'll go around the horn here.
Thank
Steve.
you, Dave. And by the way, I do want to remind our listeners, look, if you've got additional questions about anything that we've talked about today, reach out to your BOK Financial representative. Let's have a conversation. There's a lot for us to talk about, and we'd love an opportunity to visit with you about your financial future. You know, I've been unbelievably fortunate to have been involved in the investment business for 43 years now. One of the things that strikes me, and all the things that I've seen as I've gone through that, the crash of '87, the tech bubble bursting, the financial crisis, the pandemic, and by the way, I've seen enough. I'm not asking for any more, but the thing that has become clear over all of that period of time is the importance of being a disciplined investor. So whatever your outlook is, stay disciplined to your plan. If you don't have a plan, get a plan. But as we sit here today and we think about where we're going in the future, there's absolutely nothing here that would do anything to say, I'm going to quit investing. I'm going to quit saving for the future. We're incredibly optimistic. We think the best is yet to come with this economy. So stay with that plan, stay disciplined to what you're doing from an investment standpoint, and that's how you're going to give yourself the best opportunity to achieve those longer-term financial goals.
Matt, final
Sure.
thoughts?
I'd just say that, look, I want to make sure we leave a clear, optimistic message. The fact is, over the next 12 months, we're looking at a consumer that's strong, a government that's going to be partly out of the way, and capital spending, which is one of the best ways to grow an economy, that's going to be like we haven't seen in many, many years. And when I look at that, I say that could be a really interesting 2025, but more importantly, the productivity gains we could start creating as we adopt AI into our businesses, into our processes, that could benefit us for the next 5 and 10 and 15 years. And that digs us out of the debt to GDP hole that we have. And so I am optimistic. I'm looking forward to the future. I want to remind everyone we are in year 3 of a bull market. Year 3 of a bull market historically has been very modest returns, but that does not mean that the economy that we're talking about here, where we see this potential for growth, where we see this potential for a next wave of productivity coming at the same time as deregulation and the power that could bring to the economy, to the American consumer, to the wealth of the American consumer as well. I don't want to underestimate that. So,
Brian, your final thoughts as well.
You know, it is very exciting to listen to today about all the opportunities, and I think it is right to have an optimistic view as our base case for the markets and the economy, certainly over the next 12 months. And we're positioned that way with our investment portfolios. But there is a lot of change going on, and it will be bumpy, whether it's from fiscal side, monetary policy side. We didn't even really talk about geopolitics, that all have the potential to add volatility to these markets. And so how do you get through that? In the BOK way, for many, many decades, for our longer term investors, is yes, you have your base case view, but there is slim probabilities of some other paths that can happen, scenarios that can happen with the markets. And how do you position portfolios like that? The BOK way is to stay very diversified. We will always approach building investment portfolios diversified by asset classes, diversified by geography, diversified by capitalizations, and that has served our customers very well. And that's the path that we're going to go down. A couple other things, though, Dave. Listening to Steve and listening to Matt, there was a lot of interesting, not well-known things going on in these markets in the economy, and I'm really proud that they're part of the team to be able to share this, and we'll continue to do that. We have many other investment experts back at the bank in the home office that we get out in front of our customers, and they're available. And we will continue to update our customers on our latest views on the markets and the economy, which is the BOK way. And then finally, Dave, just thank you for leading this discussion this morning. You've done a great job, so thank you very much.
I appreciate it. And, and additionally, as we mentioned, BOK Financial, they have taken that deeper look at all the topics discussed today with written commentary. It's available on BOK's financial website, and you can receive a link for that in your email. So, gentlemen, thank you once again, each and every one of you, Brian, Steve, Matt, for being with us today. And thank you at home for taking time out of your day to do this with us. We appreciate it. Have a great day, everybody.
Thank you.
thank you.